Hi everyone, welcome to Anu's classroom. In this video, we will be talking about the cost sheets. Last video, we tried to understand cost and the various elements that make up total cost. In this video, we will be moving further on our discussion on understanding costs and try to understand what cost sheets are. So let's get started. By the end of this video, I hope that you will have an understanding of what a cost sheet is, why we prepare cost sheets, what we can and cannot find in a cost sheet, how we use cost sheets as managers, and we will also see a very simple cost sheet format and an example of a simple cost sheet. So let's get started. Why actually should managers be concerned about costs? Let us have a quick recap. Understanding costs is vital for informed business decisions. It helps you determine the profitability of your operations and how you can set prices. Understanding costs will help you as managers to ascertain costs and control cost, determine the total per unit cost, distinguish between profitable and non-profitable activities, compare costs over time, and reduce or control costs. So knowing that as managers we must be concerned about cost, we also learned about how we can break down total cost into the direct cost of materials, labor and expenses plus the overhead cost of factory, office administration and selling and distribution. So let's take the discussion forward and understand what a cost sheet is. A cost sheet is a formal document of the fixed, variable, direct and indirect costs a business incurs from the start to finish in its production process. And based on this information, a company can determine the total production cost and fix the price per item for the commodities. Cost sheets are more common for these production-based businesses, but they also come in handy for service providers. As long as you need to track resources for your business operations, a cost sheet is a must-have. So, what all are the things that you could find in a cost sheet? A cost sheet has four major components, which are the prime cost, the work cost or the factory cost, the cost of production or office cost, and the total cost or the cost of sales. The cost and as well as the cost per unit from the product, which we can derive from the total cost. The percentage of every expenditure is mentioned as a percentage to the total cost, and we can use it to compare the cost of any two periods and ascertain if any inefficiencies are there or not. It provides information to management for cost control, and it helps in calculating and summarizing the total cost of the product. Now, a few things that you will not be finding in a cost sheet are the costs that are related to capital assets, appropriation of profits, amortization of fictitious or intangible assets, abnormal gains and losses or items of a pure financial nature will not be found in a cost sheet. Now, as managers, how we can use cost sheet to our advantage or how cost sheet help us are, cost sheets will help us in calculating the total cost breakup for determining the selling price. It facilitates comparison, facilitates managerial decision making, preparation of budgets and tenders as well. A broad classification of costs, as we said in the last video, we found that there are costs associated with direct material, labor or expense as well as indirect material, labor or expense. So over there, the way we classified costs was on the basis of whether they can be directly attributed to our product or service or whether they'll have to be indirectly attributed. Now, another aspect of cost or another classification of cost is based on whether they are fixed costs, that is costs which remain fixed. If you are renting a building, then your the building's rent is a fixed cost. It will not change depending upon your production volume. It will change only if you choose to rent an additional building, or if you choose to not rent a portion of the building which you were earlier renting, right? So only on those cases will the rent as a cost will fluctuate. Otherwise it will not. Similarly, if you have any insurance expenses or remunerations you paid to directors or other senior managers or even your employees will not change unless you decide to terminate an employee. The cost remains the same no matter how much ever production is, how much ever you decide to increase the production. Whether you make your worker produce 1 unit or 10 units, as long as they are being paid for the shift time that they are in the office, your cost to the employee does not change. Then comes the variable costs, which are costs having a variable nature. That is, they keep on changing proportionately with the production level. Like for example, the cost of raw materials. If you need to produce 100 units instead of 10 units, naturally you will need that much higher amount of raw materials. Similarly, if you are producing just 1 unit, then you might produce the unit and off the electricity supply. But if you are producing 10 units, then you will have to keep the machine on for a much longer period of time, which is not actually how big organizations work with mass productions, because they have their machines operating 24/7 unless it is shut down for any maintenance. But let us think about it in a small setup. Naturally, if you are a small producer, small scale business starting up, whenever you are producing it, you might, whenever you come into the room, you will on the lights. If you are going out of the room, we are supposed to off the lights, right? So the reason why we do it is so that we make our costs variable, and we try to save up on the variable aspect of the cost. Electricity is one such thing which is actually variable and which we can control to an extent. Now, when we are preparing cost sheets, we consider both the fixed as well as these variable costs. A simple format of a cost sheet can be thought of it as like this. We have the cost associated with the direct materials purchased. We will add the extra or the variable costs which come up with what you can say the stock of raw materials. Okay, we add the opening stock of raw materials and we will reduce the closing stock of raw materials. Like for example, let us say you purchased 10,000 rupees worth of raw materials. Okay, now before you purchased, you might have had maybe let's say 5,000 rupees worth of raw materials already in hand, but that was not enough for the order that you are that you will be putting out. So you additionally ordered 10,000 rupees worth more. So now your cost of direct material purchased will become 15,000. Now at the end of the production cycle, maybe you have 2,000 rupees worth of raw materials left for the next cycle. So that 2,000 rupees worth of raw materials was not consumed by you. Therefore, from this cycle cost sheet, we have to reduce that 2,000 rupees. So it will become 15,000 minus 2,000, that is 13,000. Next, so that is the total cost of your material consumed. Then to that you have to add direct wages as well as direct expenses to get the prime cost. You have to add up factory overheads and as well as the opening stock of work in progress items, whereas you have to reduce the closing stock of work in progress items to get the work cost. You will add up the administrative or office overheads to get the total cost of production, as well as we will add up the selling and distribution overheads. Now we will also add up the opening stock of the factory goods that are there with us, and we will less the closing stock of the goods to get the cost of sales. And we will also add up our profit margin which we are expecting out of the sales to get the final selling price. So that is a simple format of the cost sheet. Now we'll see it in action. Okay, so this is the example of a cost sheet of a particular company, say ABC, prepared for the year 2020 to 21. As you can see, we have a direct material consumed worth 30 lakh rupees. They had an opening stock of raw materials worth 18 lakh already with them, and on top of that they had ordered 30 lakhs more. So that becomes 48 lakhs in total. Now at the end of the cycle, when they were preparing the cost sheet, they had 2 lakh worth of raw materials which were remaining. So that will make it 46 lakh rupees. As direct wages, they had to provide 20 lakh rupees, and as direct expenses, they had to give in 10 lakh rupees. So totally their prime cost comes to be 76 lakh rupees. Now they had a factory overhead worth let's say 20 lakh rupees, which makes the work cost become 96 lakh rupees. They had an office and administration overhead also worth 90 lakh 20,000 rupees, which makes the total cost of production as 1 crore 15 lakh 20,000 rupees. To that they are adding the opening stock of finished goods, that is which was worth 2 lakh 50,000 rupees, making the total cost of goods that were available for sale, that is this opening stock of finished good is when the accounting cycle started for 2020. They had 2 lakh 50,000 rupees worth of finished goods already in their inventory, which is ready for sale. So the total cost of goods available for sale becomes 1 crore 17 lakh 70,000 rupees. At the end of this period, that is at the end of 2021, while we were preparing the cost sheet, we had 3 lakh 50,000 rupees remaining. Okay. that is the closing stock of finished goods, so that we can reduce it from this cost sheet, making the cost of goods sold equal to 1,14,20,000 rupees. And to sell those things, they had to add a selling and distribution overhead of 10 lakh rupees, making the total cost of sale as 1,24,20,000 rupees. Now they were expecting a 20% margin, that is what you can say 24,84,000 on this sale. Okay, the cost of sale, they wanted 20% margin. So if they have to get this 20% profit margin on their cost, then they should be selling the goods, okay, for they should be getting sales worth 1,49,04,000 rupees. Now since I know the amount of sales that I should make, or the total sales revenue that I need to generate from this particular cost sheet of 2020 to 2021, and I will definitely be knowing how many units of goods I have already produced by the end of the cycle, I can simply divide this amount with the number of goods produced to get the per unit selling price, which I have to sell my goods for in order to get this 20% profit. And not just that, I also need to sell up the entire inventory. Okay, entire inventory minusing this finished goods worth 3,50,000 rupees, and remaining everything I should be finishing up in order to get that 20% profit. So that was it for cost sheets. I hope you understood cost sheets and how we can get information from them, and as well as how we can write or prepare a cost sheet. As managers, more than MBA graduates, more than the expectation of us being able to prepare a cost sheet, what is more important for us is that we be able to read the cost sheet and understand it and make decisions. At the same time, if you are taking finance, then naturally, definitely you will also be expected to be able to spot any fraudulent activities in the cost sheet. So that was it for this video. Thank you very much. Thank you for your attention if you have made it so far. See you in the next video. Bye-bye.